Hi everybody, my name is Matt Birkbussel. I'm the Manufacturing Industry Director here at HSO UK. Very pleased to be joined with me today with Fahim Khan, who is an economist at Make UK, and we're here to discuss the manufacturing economic outlook. It's the third quarter survey that Make UK have done. Fahim, great to have you here to take us through what's been probably slightly, I guess, disappointing, but maybe not totally unexpected view. So, I guess just to begin with, what's been the overarching theme of this quarter's survey?
So thank you very much. It's lovely to be back here. So what we have found from our third quarter research, and quite surprisingly, or at least whilst we knew this would have come eventually, we weren't expecting it so soon, is that there has been a deterioration in business activity within the manufacturing sector. The reason why this is so shocking to us is because in context of what's happened in the start of the year, manufacturers are actually overperforming in output and orders. Actually, businesses were doing very, very well. At the time, we attributed that to easing supply chain disruption. So we had many businesses who had a backlog of orders and they had half finished stock. Think of like washing machines with their doors missing, sitting in the warehouses, and those doors were finally starting to come in. And we would describe that as the missing golden screw. And we thought that was going to carry industry activity throughout the rest of the year. But we've seen that dry up very, very quickly after the first 6 months or so. So the third quarter paints a pretty sobering picture of where the industry is at the moment.
So would it be fair to say then maybe at the beginning of the year and into the second quarter that was kind of a blip, a hangover from obviously post COVID, and as you say, with some of those supply chain difficulties, and that's kind of masked obviously what we're seeing now with more of the headwinds in the economy.
Yeah, I think a lot of it is down to businesses were pretty much reliant on the backlog of orders that they had. So they had a huge pipeline of orders that perhaps built up post COVID during the recovery period. And it was never actually clear when that was going to necessarily disappear. But we've seen that start to evaporate finally. And those orders and the backlog are not being replaced by or any new orders because actually it's not just a UK market that's slowing down, it's also international markets that are slowing down. And it hasn't helped that the Bank of England's aggressive rate of raising interest rates has actually probably accelerated that slowdown.
Yeah, I was going to touch on that in terms of the factors behind the slowdown, and I think most people would recognise the impact of the never-ending interest rate increases. So yeah, what you were saying about the interest rates is obviously, I think most people will recognise the impact that that's going to have in terms of trying to attack inflation. There are other aspects as well that I picked up from reading the report, and obviously one of the key things, and this has been an ongoing, I guess, campaign with Make UK around having an industry strategy, which has been lacking for many years. But there's obviously a lot of uncertainty, political uncertainty within the UK. What sort of impact is that having on manufacturers?
Yeah, I think the biggest impact that we're seeing is probably on investment. And I'm just going to bring up a slide to show you or to reflect that. So what we're looking at, so what is the need of an industrial strategy? Well, I think for one thing, it's about providing certainty to businesses, especially manufacturers who are looking to grow and invest in the UK. And what we're looking at here is the movement in employment within the manufacturing sector, which are the red bars, and the investment intentions, which is the orange line. And now, whilst employment is a metric that changes in real time, investment is actually measured in terms of planning to of the next 12 months, which can be heavily impacted by what's happening in government policy. As you can see, it's actually quite a volatile metric. The reason why I think there's been this issue around underinvestment in the UK with manufacturing, and the lack of a strategy has impacted businesses' ability to plan for the future. Now, at the moment, investment intentions are actually quite good because what we've seen is that the reducing rate of inflation has actually benefited investment intentions in the UK, but there is still some concern around whether or not the type of investment manufacturers are making are necessarily the right ones to continue growth in the UK. We did a survey actually to earlier this year, which showed that around 80% of manufacturers said that the main reason that they were not able to grow in the last decade is because of the absence of an industrial strategy. And I think this really is a testament to how policy has been run maybe over the last 10 to 15 years. Just to give you kind of a bit of context on that, in the last 15 years, we've had about 7 different plans produced by the UK government that you could maybe liken to something of an industrial strategy. It wasn't always called that, it always had a different name, but there were 7 different plans with some sort of intention to grow the economy. In the last 15 years, that means that the average length of a long term plan for the UK government is about 2 years. And that is not a lot of certainty and longevity for businesses who are planning, especially new businesses who are innovating new products and are going out to market, trying to attract investors. What happens is often manufacturers struggle to convince businesses to invest in their product because there's always a question mark over the heads of the UK economy, saying what is actually the UK's plan. Why does this matter? It's because we don't have a plan whilst other major economies do. The US has a plan with their investment in the Inflation Reduction Act. The EU is counteracting that with its own Net Zero Act. And even other industrial economies like China also have their own long-term visions for sector, whereas the UK is probably the only Western economy that seems to lack one.
So it's quite a telling story, isn't it? I mean, is the UK a good place to do business for manufacturers?
From my perspective, I think it's a great place to do investment for manufacturers. We are one of the heaviest investors in R&D. So 40p of every pound comes from, or that's invested in research and development in the UK, comes from manufacturers. We're one of the most investment heavy sectors in the UK. So 16% of all business investment is contributed by manufacturers. Whilst that doesn't sound like a very big percentage across all industries in the UK, they actually is the highest one amongst all of those. But I think the challenge that often businesses find is that we are always going to be compared to our competitors overseas. And whilst the UK is a great place to invest, sometimes other countries like France, like Germany, like the US do something slightly better where they offer slightly better incentives, slightly better subsidies to promote their sectors, but also their governments just on the simplest level communicate to their business community saying you are a priority, we're going to continue investing, so you're going to be here for the future because this sector matters to us. And that's the simplest thing that we somehow fail to do.
And I guess the positive impact of having a strong manufacturing sector is that other sectors that can support, we've always had a very strong services sector since the late 1980s. But the benefits are, if we've got a strong manufacturing base, then those other sectors get the benefits as well.
Yeah, I think whenever you look at the numbers, it's easy to think, oh, because services accounts for about 80% of the economy, then that must be the industry. And actually, most economies, even the industrialized ones, tend to have a larger service sector than their manufacturing base. In the UK, it's about roughly 10% of our economy in GDP terms, maybe a little bit lower now. In the US, it's about 10% as well. In Germany, I think it's actually closer to 15%. Most of these economies are actually very similar in terms of the nature of their composition in the economy. But the mistake that we make is that we put too much emphasis on that service. Actually, many of the existing services in the UK are very deeply connected within the supply chains of manufacturers. So thinking about, let's say, the hospitality sector, a lot of the equipment, the tools, the furniture, the food and drink they buy, all of that stuff is bought from manufacturers who build them, produce them. If you're thinking about bankers, even, many of them advise on mergers and acquisitions in investment banks. Who are they often advising on? Usually manufacturers that are growing in different countries who are merging with others, with acquiring other businesses. If you're thinking about the stock trading market, what are the stocks that they're usually trading? Usually businesses that are manufacturers on in most cases. So actually, the composition of manufacturing can be a misleading can lead to a misleading interpretation of how important that sector actually is to every other industry that operates in the UK. And actually having a domestic base, because I think the question we'll often ask after, well, do we need it to be here, or can we still get those services even if the manufacturing base is actually somewhere else? And I think the challenge is that if the manufacturers were to move away from the UK, you'd also get a lot of the services moving along with it, because actually they do rely on that customer base for all their work. So it's difficult to quantify how important manufacturing might be, but I think it's often overlooked, the role that it can play in the UK economy.
Mm. No, no, great insights there. Well, I guess we should probably take a look at some of the highlights of the report. I was quite shocked to see the decline. I mean, we talked earlier about the order books of manufacturers, and obviously quite a significant decline from 24% down to, was it 3%? I think it was. So maybe we could let's take a look at some of the highlights.
Yeah, let's look at the main slide there for this one. We have five different indicators around output, orders, employment, investment, which I have already shown you, and also we do look at behaviors or businesses when it comes to setting prices. But the main thing we look at for activities, first and foremost, is output and orders. Now, what we're looking at here is a time series of the activity levels over the last 6 or 7 years or so. But if we're looking at just towards the most recent year, we see that manufacturers in the first 6 months, and I don't know if you can see my mouse hovering over the two penultimate bars, performed very well in the UK. Actually, output was exceeding nearly 20%. Order books were actually growing faster than output levels. We saw the order books slow down a little bit in Q2, but again, we found that activity was very, very strong. And then suddenly everything dropped off. Output levels just hitting 3%, and actually order books have fallen into negative territory, meaning that on average across the sample, they are in decline, which suggests that if that continues, then output is probably going to be in decline. The very interesting thing is that despite the very negative performance, manufacturers themselves still remain upbeat and positive about the future. And I'll give you an indication of that. So I'm going to go to another slide here, which I think kind of adds some color to what has been happening here. There's a lot of uncertainty in the industry, and what you're looking at is the difference between manufacturers' expectations for business performance and their actual performance in that quarter. So every quarter we ask members, predict what you think will happen in the next quarter, and you can marry that time series against the actual performance when we do inevitably complete the survey. So the dots that you look here are the actual performance, and the bars are what manufacturers said that was going to happen in that quarter. And if we look at the most recent quarter now, Q3, manufacturers initially predicted tremendous growth in output and orders. They were completely wrong, and we don't know why. I think it's difficult to attribute it to a specific external factor. In the past, we would say it was the conflict in Ukraine, or it was the energy crisis, or it was the inflation. The only thing that's really had an impact, maybe in the last few months or so, is probably rising interest rates, which are affecting people's wallets and their purchasing powers. But looking forward, manufacturers are saying, or at least their predictions are, and I'm going to go to a third slide here because there's a lot of slides to kind of make this one story link together. What they are predicting for Q4 is that there's going to be a return to growth. And that actually, whilst we think the first 6 months are a blip, manufacturers think Q3 is a blip. They think that the negative performance is actually temporary. But they were very wrong about their performance for Q3, so we wouldn't put too much faith in the performance for Q4. But their expectation is that they're saying that we're going to probably have a very good Christmas.
And I noticed that from the report, there's kind of like a divergence between the business expectations and of course, what the economy is doing. I mean, have you been able to find anything that might explain that divergence?
Yeah, I think the first thing to point out is manufacturers are always positive. Even when the world is ending, they seem to think that things are going to be all right. So, to kind of add some further context into what the difference between expectations and reality means, we're going to look at this one slide here and ignoring the metrics for orders, just focusing on what businesses are saying for what they think will happen for Q4. Now, our expectation is that we believe that the first two quarters of this year probably produced a blip in the data where this was temporary growth, and now we're seeing the beginnings or the hints of a decline. But manufacturers and their expectations believe that actually it is the Q3 results, which is the decline, that is actually the real blip. They predict that Q4 is going to be very positive, and we'll have to wait and see if those results are correct, because actually manufacturers, of course, predicted a strong Q3, and that did not come to pass. So we can only put so much faith in those expectations. But at the moment, manufacturers expect a very good Christmas period for the rest of the year. So hopefully, we hope that that comes to pass, but we're very cautiously optimistic about that.
Yeah, I did notice it in the report this divergence between obviously business expectations versus the sort of economic realities of it. Is it just the nature of manufacturers to be positive, or is there anything that you could say, well, this is why they are thinking in this particular way?
I think the first thing is, you're right. Manufacturers are always very upbeat. Either the world could be ending, and they would say, you know what, next week's probably going to be better. I think that's the probably the biggest difference between them and me when I'm an economist, and my entire job is to present doom and gloom to the rest of the world. So I think it's always a good thing that they're so optimistic. I think it means that they always invest with the intentions to grow rather than to protect. But I think it's also about where the economy is heading right now. We are approaching an election year, so businesses are expecting a little bit of instability in the short term. They are also seeing interest rates rise, but if that does lead to a recession, that is an indication that in the future there won't be a recession, because once there is a decline, there has to be some sort of bounce back, because since we operate in boom and bust cycles. So manufacturers are continuing to invest despite seeing a slowdown in their growth. It is difficult to say exactly how long that's going to be sustained for, because I think if they do have a second quarter of decline, that might change their expectations of what they think 2024 will be like. Because at the moment, if you look at the entire year, they've had a bad Q3, but they had a very good Q1 and Q2. So in terms of track record, they're probably doing better than worse in most cases. So it's too early to say if the rest of the year is going to be a poor one.
Yeah, and interesting what you just mentioned about the fact as you said, entering into this election cycle, and obviously last week's announcements were probably just the first beginnings of the first things, and conference season's now just about to be upon us. So I can see that we'll get some more announcements as well. What do you think the potential impact on some of those decisions that were made last week, particularly around net zero? What likely impact is that going to have, either in terms of investment plans or even employment within the industry?
Yeah, I think we need to be very careful about how much faith we put on whether or not businesses actually follow government policies to decide what they're going to do with their business plans. Now, the first message we get from government on the reversal on some net zero, I guess, metrics or targets we had set, sends a bad message to the rest of the world. It suggests that the UK is not necessarily as committed to net zero as some other countries. Now, whilst those targets remain in place, it means that businesses who are, let's say, trying to be more green, trying to promote more, become more net zero themselves, may struggle to access finance for those projects, because once you reverse a target once, there's going to be this cloud or this question mark over your head, thinking, well, actually the UK could change more targets from this point. It's not just these net zero targets. We've now moved the sale of diesel cars to 2035, but there's no reason why that might not end up moving to 2040 or 2050. Once you've done those, moved away from those commitments one time, you could move it again, and that kind of reduces the faith that people can have in the UK economy. It will reduce how businesses view that. Now, how manufacturers themselves are going to react, And we've had some discussions with our members on this. And many of them are unlikely to change the trajectory of their own net zero plans because of this. Actually, many businesses now see be decarbonization and making energy efficiency as a good business decision. It saves them money, it saves them costs. It's actually a more efficient way to produce. And so most manufacturers, it doesn't matter what the government target is for 2030, 40, 2050, they will not change their plans to make their own targets because it's a good business sense. And quite often, especially when you speak to SMEs and you ask the CEOs, what's driving you to do this if it's not the government, many of them will often point to their children and their grandchildren and saying, we need to leave the world in a better place for them. So it doesn't matter what the government's target is. So whilst we don't like the message that the actions send from what the government has done on this net zero reversal policy, we don't think it will have a huge impact on the way businesses will behave because many of their plans are already set in stone.
Okay, no, interesting. And again, I think there is some positivity there. The fact that manufacturers are going, well, no, we'll own this ourselves, and we'll stick to our plans. There's a couple of other points just to move on that I wanted to touch upon. We haven't yet talked about the differences between obviously the UK market and the export market, but would you like to just touch on that and I guess which parts? I mean, obviously the EU is probably our largest export market, but what other markets we might be benefiting from?
Yes, and I think I'm going to bring up that slide again on the difference between domestic and export markets. We can have a quick look at that. Um, So what I'm presenting here, and we were looking at the forecast bar earlier, but I'm going to look at the rest of the data this time. So we're seeing the orders performance in this quarter, but broken down between domestic and export. Now, since the pandemic, we've actually seen the domestic market, which are the red bars in this series. And so if you're looking at post 2020 Q4, almost outperforming the international market every quarter. And I think it's done that every quarter since the second quarter of this year, where the performance of both international and domestic markets was equal. We've seen both of those markets now decline in an equal rate this quarter, and that is unfortunate. But the expectations suggest that businesses in the UK do believe that the UK market is probably going to bounce back a little bit faster than the export market. Now, you know, I don't want to go back to always talking about the B word all the time, but of course that did have an impact on business trade. However, according to our own kind of analysis, our findings show that the European Union still remains one of the biggest markets for UK manufacturers, and whether we have a trade deal with them or not isn't necessarily going to change that. We have, of course, made some positive steps forward by doing trade deals with countries like New Zealand and Japan. And we're looking at deals with Australia, and I think we are joining the CTPP, which will perhaps open some trade routes or opportunities for manufacturers. And to be honest, many manufacturers trade with these countries already, and they're already used to trading with them under WTO terms. I think the big challenge is that the growth that we are experiencing in those new markets isn't necessarily enough to replace the demand that we may be losing from the European Union. Geography matters. Physical distance between countries actually does make a difference. And also, if we are thinking about net zero, we need to think about the mileage that our goods and services produce. But it doesn't make sense necessarily logically to buy milk from New Zealand because it's going to go off by the time it lands in our airports. Whereas it does make sense if we had to buy them from France because it's only a few hours away. So whilst manufacturers are taking the opportunities where they can to grow their exports in new markets, we're not seeing much of a diversion away from the European Union because actually, in terms of business cost sense and logistics and just relationships that already exist, trading with the European Union still remains the most sensible choice for many manufacturers that are growing at the moment.
Okay, no, thank you. And then the other area that I wanted to talk to you about was the impact on prices and margins. I mean, there's fairly significant pressures on both of those. So, you just share your insights on that topic.
Okay, happy to. So yeah, thank you for that question. That's really, really important what we're seeing in terms of the behavior of manufacturers and how they are setting prices. So we know why the Bank of England set out to raise interest rates in the first place. It was to tackle inflation rates, which were at record highs in the UK. We know the consumer inflation rate was around 10, 11% at its peak, and actually producer inflation was more than double that at one point, around over 24%. What we found is that during the 2021-2022 period, manufacturers are raising prices on their goods at almost record rates. We had to rescale the entire chart that you are looking at now in order to fit in the red and orange bars that represent the share of manufacturers who are raising prices on their goods. At the same time, what we saw is because costs were rising so quickly at that time, manufacturers were genuinely struggling to recoup, to actually make any profits, even though they were raising prices, because actually costs were changing faster than they were able to change prices on the market. What we've seen in the most recent data, and mind you, the Bank of England has raised interest rates now 14 times since late 2021. On the 15th, they decided not to raise it any further, and that's probably a good thing for the rest of the industry. But we've seen manufacturers' price setting behavior starting to return to normal levels. So, actually, less and less businesses are now raising prices on their goods, which suggests that costs are falling. It's giving a little bit of breathing space for industry to catch up on its margins, and we are seeing margins catch up. And it does signal to businesses that the Bank of England's strategy, at least on paper, might be working. Inflation is falling, businesses are reducing prices. Unfortunately, that is coming at the cost of reduced employment and also reduced orders, which itself is going to actually be quite damaging to the sector.
Yeah. Are there any sectors that stand out in terms of performing better than others, would you say? And also, kind of related to that, is the size of the business, does that have an impact in terms of how they're performing?
Yes, I think so. Looking at the individual industry performance, we do see certain sectors who are still almost going through that COVID bounce back period. So they actually still have a backlog of orders. One that comes to mind is the automotive sector, which actually is predicted to grow quite significantly in 2023, despite the rest of the industry in decline. We are also seeing improvements in industries like electronics and mechanical equipment as the semiconductor shortages start to ease. We're seeing more of those businesses seeing a rejuvenation in their order books. By business size, it's very tricky because it does depend on the metrics you look at. But in terms of output and order performance, we are seeing better performances from those companies that are on the higher turnover range. So we break turnover by under 10 million, between 10 and 24 million, and anything above that is a larger business, 25 million and plus. Those manufacturers are actually their output has not declined as much as the rest of the sample. Their orders has not and I'm talking about the 25 million plus businesses here, their order books have not declined as much. Their investment intentions are also higher. They're not making as many redundancies. It's very clear that even in times of economic decline, bigger businesses tend to be more shielded because they have more reserves in terms of cash, they have more expertise, they also have more soldiers, say, to take advantage of government support when that exists. Where in SMEs, you could have capital allowances and tax credits, but then they don't necessarily have the expert in the room who knows how to actually make use of these tools to help their business. Whereas larger businesses will often have a dedicated team of individuals and accountants who can ensure that their business is as viable as possible, but also to forecast more accurately what's going to happen in the rest of the economy, which enables them to make better decisions in the short run. So we are seeing that impact, and I think that impact, even in times of growth, is also observed that the bigger businesses tend to do better than the smaller ones in terms of growth is quite normal.
No, good. Thank you for that. My final question. It feels as though we are on a little bit of a knife edge in terms of the economy and growth. Um, I'm hopeful that we're not going to have a recession, but as an economist, I'm going to ask you the question: are we going to be able to avoid a recession?
I think that it is unlikely that we will avoid a recession because it is purely the intentions of the government and the Bank of England to almost artificially create one in order to bring the economy back on track. I would say that we're not looking at any recessionary or contractionary time periods that are going to be anything like the financial crisis we had in 2007. It's not going to be anything like we had in those few months of the worst period of COVID. It's going to be quite mild, but even that mild recession will be costly for some people because there will be some people that will lose their jobs, and we are seeing that impact already taking place. But as manufacturers are behaving today, it suggests that they don't believe that's going to last a long time, and we would agree with that view that it's going to be a very short one, and businesses will bounce back from it.
Okay. Well, on that note, Fahim, I'd like to thank you very much for your time today. It's been great talking to you, getting your insights, and getting that better understanding of what things are like for manufacturers at the moment. So, thank you again.
Thank you.